Welcome to The Explainer. Today, we're unpacking a truly fascinating financial strategy, how to get paid every single month by your investments. If you've ever wondered how passive income actually works in the stock market, or how people manage to build a portfolio that literally pays them just like a regular job, well, you are exactly in the right place. We're going to demystify the mechanics of monthly dividend investing, breaking it down step by step so you can really understand the power of continuous cash flow. Here's our roadmap for today. We'll quickly cover what monthly dividends are, the perks of passive income, the risks you definitely want to avoid, how to evaluate these stocks, some real-world examples, and finally, figure out if this strategy is right for you.
Okay, let's dive into this. Section 1. What are monthly dividends? We need to start with the basic mechanics.
So, dividend stocks are essentially companies that choose to distribute a portion of their profits right back to you, the investor, on a regular basis. Think of it like this. Imagine you own a tiny piece of a local coffee shop. When they make a profit at the end of the month, they hand you a cut of the cash, right? In the stock market, when a mature, stable company succeeds, you receive a direct cut of their profits without lifting a finger. For a super basic example, if you own 100 shares of a company paying 10 cents per share monthly, you simply wake up to a $10 deposit in your brokerage account every single month. Let's break down this simple life cycle of how those corporate profits actually make their way into your pocket. It really boils down to 3 straightforward steps. Step 1, the underlying company operates its business and, makes a profit. Step 2, the company's board of directors officially declares a dividend, deciding exactly how much of that profit will be distributed per share. And step 3, you, the investor, simply receive a cash payment deposited directly into your account. It is a remarkably clean, efficient mechanism for generating income. Now, the vast majority of traditional dividend-paying companies out there distribute their cash on a quarterly, meaning 4 times a year, or sometimes even an annual basis. And honestly, that can create some pretty irregular, lumpy cash flow for an investor. But monthly dividends, they offer 12 payouts a year. The absolute brilliance here is that this schedule perfectly aligns with how most of us actually live our lives. We pay our rent, our mortgages, utility bills, and streaming subscriptions on a monthly basis. Monthly dividends match that exact same rhythm. Moving on to Section 2, the perks of monthly passive income. Let's look at why getting paid 12 times a year is an absolute game changer. And this brilliantly illustrates the difference. With traditional quarterly income, you get a sudden spike in cash followed by a multi-month dry spell where absolutely nothing comes in. And then, boom, another spike. Budgeting around that can be super stressful. But monthly income, it's smooth, consistent, and highly predictable. It mirrors a regular paycheck, making budgeting significantly easier if you rely on your investments to cover actual living expenses. Now, what if you don't need the cash right away? Well, you can use a dividend reinvestment plan, or DRIP. This means automatically using your cash dividends to instantly buy more shares of that underlying stock. For example, if your stock pays you $10 this month, that $10 automatically buys a fraction of a new share. Next month, that brand new fraction pays you its own dividends right on top of what you were already making. It's this incredible snowball effect that turns small amounts of regular passive income into serious long-term wealth. Which brings us to the mathematical magic of this specific strategy, captured in a single number, 12. Because you're receiving your payouts monthly instead of quarterly, you are reinvesting and compounding your money 12 times a year instead of just 4. That means your money gets put back to work in the market so much faster. Over long periods of time, this frequent compounding mathematically accelerates your wealth building in a very meaningful way. Section 3, risks and mistakes to avoid. Let's pump the brakes for a second and look at the downsides impartially. First things first, dividends are never completely guaranteed. If a company hits hard times, experiences a severe drop in sales, or faces a recession, management can absolutely slash or even eliminate that monthly payout entirely just to save cash. You also have to contend with standard market volatility. The actual price of the stock is going to fluctuate up and down regardless of the dividend it pays. This makes diversification incredibly essential. You never want your entire income stream dependent on just 1 or 2 companies. And this leads us directly to one of the most dangerous mistakes an investor can make, the high-yield trap. When you are looking for passive income, it is so tempting to chase extremely high yields, like a stock suddenly paying a 12 or 15% dividend. But beware. Often, an unusually high yield is a giant red flag signaling a distressed company. Remember, yield moves inversely to stock price. Often, the yield is only that high because the underlying stock price has plummeted due to severe financial trouble. Blindly chasing these can act as a trap that literally costs you your original investment when the company eventually cuts the dividend completely. So the crucial point is, How do we actually look under the hood to find safe, sustainable monthly payers? That's Section 4, Evaluating Monthly Dividend Stocks. The absolute best place to start is the payout ratio. This is the percentage of a company's total earnings paid out as dividends, and it's the ultimate indicator of payout sustainability. For instance, if a company is earning $1 per share and paying out 50 cents in dividends, its payout ratio is a healthy 50%. They have plenty of wiggle room. But if they're paying out $1.10 on a single dollar of earnings, well, they're bleeding cash. They are paying out more than they can afford, and that monthly dividend is highly vulnerable to being cut. Beyond just the payout ratio, you really need a full dashboard to gauge long-term health. Check the dividend yield for your immediate return, sure, but pair it with dividend growth to ensure payouts rise and beat inflation over time. Crucially, look at their cash flow and earnings stability to ensure the underlying business is actually robust. Finally, check those debt levels. A company drowning in debt will always pay its creditors way before it pays you. Section 5. Popular real-world stock examples. Let's make this tangible. Let's move to and see how this builds with some real, well-known companies using this model. Many are real estate investment trusts, or REITs. For instance, Realty Income is a massive player in commercial real estate that actually trademarked the phrase, the monthly dividend company. There's Stag Industrial in warehousing, Agree Realty in grocery stores, and LTC Properties in healthcare. We also see companies like Main Street Capital in the investment sector. What they all share is a business model structured specifically to generate highly consistent, predictable cash flow to fund 12 payouts a year. Finally, Section 6. Is this right for you? Let's turn the mirror back to your personal financial goals. So who actually benefits most from these stocks? Well, for beginners, monthly dividends provide immediate psychological motivation. Seeing cash hit your account every 30 days makes investing feel very, very real. For retirees, it's a perfect match for handling monthly living expenses without having to constantly sell off shares. And for long-term wealth builders, compounding those dividends 12 times a year is a remarkably powerful tool to snowball wealth over decades. Which leaves us with a final, provocative thought. Are monthly dividend stocks the right engine for your passive income portfolio? Whether your goal is to pay your utility bills today or relentlessly compound wealth for the next 20 years, getting paid every single month is a compelling strategy, absolutely well worth exploring. Thank you so much for joining me for this explainer. Stay focused and happy learning.